Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Well, finally, Friday fever seems to be kicking in for the markets as risk assets had a good day. Not to a large extent, but better than what's been happening in this week. But the story still hasn't changed. Yields continue to rise on the longer end of the curve, and especially yesterday, we observed good movement in yields of other countries like UK, EU, as well as the US. We had the US GDP and jobless claims data yesterday, and now the focus will be on the PCE figures. Morning, JK. Thoughts ahead of PCE? Yesterday's slight risk on more related to month-end buying or something more to come?
Good morning, Swaraj. Yes, we are on the last day of the financial half-year end and also the quarter end. Yeah, there was a reversal of sorts in many markets yesterday. The yields came down. The long bond yields in the US came down. And in fact, even the short-term yield also came down quite a bit. I will explain the triggers. And then we had a fall in oil prices. Brent had touched almost 98 and it came down to 94. We had stocks that gained eventually for the day. And also the dollar made some sort of a reversal to the downside. So there were some fundamental drivers. Also, there is some, technical factor, that is the month end and the quarter end, which is leading to some sort of a position adjustments. Yeah, first on to the yields. The data from US, the GDP, came as expected at 2.1%. But if you look at the details, the consumption has actually, taken a hit. It has come down quite a bit compared to last quarter, from 2.54% to 1.14%, and this is the lowest in the 5 quarters. And very pleasingly, the price index also was down from 4.9% to 3.7%. Definitely, this is something that would please the policymakers. In fact, one of the members, Mr. Goolsbee, who has all along been, quite hawkish recently, has, said some dovish statements yesterday, and he is saying he is believing too strongly in the inevitability of large trade-off between inflation and unemployment, and there is a serious risk of near-term policy error. So he's saying that we might be overdoing the interest rate, and so that factor. Also, earlier in the day, we had the German inflation. The German inflation also came down, compared to last month, and it came lower than expected as well. So that again was a factor which helped the yields to US yields to come down. So if you look at actual figures, the 30-year yield fell by 10 basis points from 4.8 to 4.70. 10-year 11 BPs from 4.68 to 4.57, and the 2-year 11 BPs from 5.16 to 5.05. And slight reduction in the number of people, or rather increase in the number of people who don't expect a change in the policy rate going forward. Now, the technical chart, if you look at, if you're a follower of technicals on the yields also, it shows a shooting star reversal pattern on the yields, which means it can fall further. So conditions have been in place, the prices index also coming down, but perhaps the market would wait for today's PCE core inflation from the US, where there is an expectation again of a moderation in the core prices, but the headline is likely to be higher, obviously because of the crude prices going up. So all in all, the fundamental picture is slightly turning in favor of yields, moderating a bit. There was an additional factor of pending home sales, which is a leading indicator of how the housing sector will perform. The pending home sales was down 7.1% in September versus 0.5% plus in August, and expectation was for a drop of just minus 0.8%. On a year-on-year also, the sales were down 18.7% from 14.3% minus. So this is a confirmation of cooling of the housing sector. So I think more evidence of cooling inflation or economic activity could put a clear cap on the yields. Now, something very contrasting happened as far as the Eurozone and UK is concerned, the yields in Europe and UK shot up substantially despite the lower inflation number from Germany. We have, of course, the Eurozone flash inflation number today. The German 10-year shot up 15 basis points, and now it is just shy of 3%. UK 10-year shot up by a whopping 23 basis points from the previous day close, and it is now at 4.59%. Now, what could be the reason? See, my assessment is that the term premium on the long bond in US corrected since June of this year, going up as much as 75 basis points. The same correction has not happened in the other countries, particularly in Europe and UK, where the long bond yields are much lower than the actual policy rate. So I think there is a scope for these yields to move up. Now, US already having moved quite some distance, these yields are now picking up, and therefore this can be a support for the respective currencies as well. And that is why we even saw the dollar index correcting yesterday from around 106.70 back to around 106.20s, and the euro dollar from just below 1.05, where I had mentioned about a strong support emerging, and it has come up to 1.0580, and even GBP, which had a lot of negative factors going for it, shot up from 1.21 to 1.22 levels. Now, dollar yen, of course, yen continues to underperform because the rise in yields in Europe and UK indirectly supports the dollar yen, because the euro yen and GBP yen are going up once again. Of course, we will wait for lots of data which is coming up today in the form of GDP data from UK, the retail sales from Germany, and the Eurozone flash inflation, finally ending with the US core PCE inflation, which is the most important data as far as Fed is concerned. Now, coming to the stock market, of course, they had several positives going for it. The United Auto Workers actually coming down on their demands as they continue their strike. The lower consumption data and pending home sales, which I mentioned, the yields coming off. And there is a news report suggesting a possible visit by Chinese Premier Xi to US in November. So that could be a sign of cooling off in the relations between US and China. So all in all, it was a risk positive day, although markets have not moved big, excepting the yields, but it looked augurs well for the coming month. But let's wait and see how things go down, because we still don't have a resolution to the US government shutdown, and no passage of pending bills. So if nothing happens by tomorrow, we will have a partial shutdown by the US government, and see how far it goes. Now, coming to the rupee, another day of very narrow range. Attempts by the market to break 83.30 in the offshore hours was thwarted once again by intervention, and throughout the day we had seen offers from the PSU banks containing the weakness in the rupee, and this is the story that has been seen for quite some time now. But interestingly, we had some external sector data from India, and that was in the form of the current account deficit, which came higher. Actually, it came lower at 1.9% compared to last year. But overall, if you see, we have been seeing a drop in the FI numbers in the recent months. Although on a year-on-year basis, it is much better compared to last year. FDI numbers have been lower. This year, actually, the private receipts have been coming down after seeing a record jump last year. ECB were positive compared to outflows last year. It's a kind of mixed picture, but overall picture is that current account deficit is going to rise to around 1.8% from around 1%, which was previously estimated, mainly driven by the private receipts as well as the higher trade deficit. Oil prices obviously contributing to it. Then we also had the external debt, which is slightly higher compared to last year at 629 billion. In terms of debt to GDP percentage, it was lower actually at 18.6% to 18.8%. Obviously, the higher GDP is lowering the percentage as well. Overall, nothing major to concern about, but the current account needs to be watched because if we do not have sufficient capital flows, then it could be a issue for managing it. But then we also had the recent news about India's bond inclusion in the JP Morgan EM bond index, and although the flows are sometime away, in medium term we are likely to get very flows. At the same time, the FTSE Russell has decided to keep it on hold. That decision was expected yesterday. So medium term, the flows are definitely going to take care of any pressure on the rupee and balance the current account deficit to a great extent. In fact, we might have a balance of payment surplus if we are to go by the estimates for the flows that are expected in. And speaking of bond market, of course, we have an event, very interesting event coming up on 12th of October, where former executive from RBI as well as from Premier Research Institute will be speaking in a webinar on India's bond inclusion in the EM bond index, the impact and also the way forward. So do mark your calendar. It will be between 5 and 6:30 p.m. on 12th October, Thursday. And we will provide further details of the same. So we are ending the half year. Hope you all had a good half year to begin, and then look forward to a great second half of the year. Thank you.
Thank you, JK. And as you mentioned, FTSE Russell bond index inclusion, that has kept basically India inclusion on hold. And of course, the very interesting webinar which we'll be having on the global bond index inclusions, and I'm sure our listeners will be very keen to understand the impact and how things will go forward. And as you mentioned, we have a former RBI member as well as an eminent economist on October 12th. So do join in, viewers. Just to quickly summarize the other data points, US GDP came in as expected, but consumption has taken a hit. We saw German inflation also coming down compared to the previous month. But what's interesting is the longer tenor yields in EU and UK have shot up. So today we have the US PCE. That will be something of that is something markets will be keenly watching, as well as the EU flash inflation and retail sales data. For rupee, we continue to trade in narrow range. We did not break into new lows as offers from PSU banks continued, but sufficient capital flows is needed to manage the current account deficit. That's it from us today. Thanks for listening. Now we'll catch up again on Tuesday with the latest in the financial markets, as Monday is the Gandhi Jayanti. So thank you for listening.